Hello, everyone, and welcome to the BP Learning Channel today. We are here to talk about Finance Keeping Gotchas, Part 2 of a 3-part series called Getting Your Books Up and Running. Gotchas that get people into serious trouble after they launch a business. People like Clarissa. Remember her? A business owner for more than 3 years, frantic every day at the office, wondering, where did all my money go? I can't cover the payroll this week. My mission today, and every day, is to cast out these horrible business demons, every single one of them, and to do it one by one. I'm Debbie, a certified SBDC coach at the Business Incubator Center, a partner with the Colorado Small Business Development Center under the SBA. I am also a former business owner myself, a former CFO for multiple startups in the Silicon Valley, and a CPA with a master's in finance. And I want to tell you about the major gotchas in the finance keeping world. They come in 3 major categories. 1, spreadsheets. 2, commingling. And 3, accounting. Accounting pitfalls, that is. These are the gotchas. Business demons I have seen consistently over the last 8 years as an SBDC coach, and that's why we are focused on gotchas today. Let's start with Spreadsheets-Demon Category 1, a serious gotcha if not used properly. They are a tool for analysis, a wonderful tool, but they should not be the primary record-keeping system for your business. They are not a good primary system because, 1, they are not a database. It is difficult to track large amounts of data in an organized manner and hard to track periods of time required for bookkeeping and accounting, month, quarter, and year. 2, there are no built-in checks and balances for data integrity. And 3, there is no automated traditional financial reporting. Let me just say, if you are tempted to use a spreadsheet to do your primary record keeping, stop right now. Don't do it. It's very, very dangerous. Next is commingling, Demon Category 2, a serious no-no, mixing your business transactions with your personal ones. Another dangerous thing to do. Here are some of the gotchas, and it's not an exhaustive list by any means. You might taint your legal status as an LLC or 501c3. Tax reporting gets complicated and more expensive. Commingling may impact the value of your business. A sale may be challenging or at a discounted price. Investors or donors in a nonprofit might not participate. Assessing business performance will be complicated. You might not know you are losing money, and trends will be skewed. The answer is, keep 2 sets of independent financial records, one for your business and one for your personal needs. And this means segregate bank accounts and credit cards and use them properly. Label those cards. I just can't stress this enough. And now, Demon Category 3, accounting pitfalls, the major ones, the scariest ones because they are elusive, sneaky, and multiply quickly. One day, you're standing there scratching your head like Casey did when he saw strange numbers in his financial reports, things that didn't make sense to him. Maybe a computer glitch somewhere, he said to himself. Maybe I need a new bookkeeper. And that's what a lot of my clients say when they come to see me. These are the gotchas I try to explain, common unintentional errors, disconcerting errors in the books, consistent errors in equity accounts, asset accounts, liability accounts, income and expense accounts, everywhere. Accounting demons wreaking havoc in everyone's books. Let's talk about business contributions. Is that contribution equity or is it a loan? Equity versus a loan or a liability. An equity demon or maybe a liability demon. Contributions must be classified as equity or a loan. In both cases, the contribution appears on the balance sheet. You get to choose where it will go, but choose wisely. An equity infusion increases value. It's an investment in the business. Bankers and investors like it because it's skin in the game. The owner is taking some risk. Loans, on the other hand, are a liability type of account. They decrease value. The business has payback requirements. The business has interest expense, but there is less risk involved due to earlier payback requirements. Big picture. Contributions are supposed to be permanent, while loans have contract terms and payback requirements. Loan payments are often confusing for people. The gotcha part relates to the principal and interest components. It's a liability demon for sure. But let me say it another way. The loan itself is not equity. The loan is a liability. Let's look at the entries that should occur on the books. There are two of them. The first entry is to record the loan received from the bank. The cash received is a deposit and a loan or liability. The bank and liability accounts both increase. The second entry is to record the monthly payment on the loan. The payment decreases the liability and bank accounts and increases interest expense. That's all there is to it. But people get it wrong all the time. Moving on now to another challenging subject, owner compensation. The question is always, should the owner take a paycheck or a draw? Owners can be paid via a paycheck or a distribution or dividend, often called a draw. In both cases, federal and state tax payments are required. The paycheck is a profitability demon, and the draw is an equity demon. Paychecks reduce profitability. Distributions, dividends, or draws reduce value. It's a charge against owners' equity. Paychecks require a payroll system. They also require a corporation, a C Corp, or an S-Corp. They also require quarterly payroll tax reports, both federal and state. Value is up when a paycheck is written, but profitability is down. Distributions or draws do not require a payroll system and do not require a corporation. Quarterly estimated tax payments, however, are required, but these payments are made by the owner, not the business. In the end, profitability is up, but value is down. Taxes can also be a gotcha, depending upon your business goals. What's important to you? Value, profitability, or saving money on taxes? Bottom line, is owner compensation equity? Or is it expense that reduces profitability? That's for you to decide with some help from a coach and your tax accountant. Next up is a different kind of demon, capital expenditures. The issue is, when you purchase something, is it an asset or is it expense? I call this gotcha the asset demon. Here's the gotcha. Purchases with a useful life greater than 1 year are called capital expenditures. These items appear on the balance sheet as assets and are expensed over a period of time. The expense is called depreciation and appears on the profit and loss statement. Let's take a look at how entries flow through the books. There are 2 of them. The first entry is to record the purchase of a truck with a useful life of 5 years. The fixed asset account truck increases and the bank account decreases. The second entry is to record depreciation for the truck at year-end, or monthly if you choose to do it this way. This is done with a journal entry which increases depreciation expense and the asset account called accumulated depreciation. It takes 5 years to fully depreciate this capital expenditure. And now, let's talk about another kind of demon, inventory purchases. The gotcha is similar. Is the inventory purchase an asset or is it expense? Yes, the asset demon again. Purchases appear on the balance sheet as assets until the unit is sold. In other words, purchases are inventory until the item is sold. The expense is called cost of goods sold and appears on the profit and loss statement. Let's take a look at how this works. There are 2 entries. The first entry is to record the purchase of raw materials, if this is a manufacturing company, or the item sold, if this is a retail business. The bank account decreases with the purchase and the asset account inventory increases. The second entry is to record the sale of the inventory item. This often occurs with a journal entry unless the company has an automated system in place. Cost of goods sold and expense account increases and inventory decreases. Importantly, inventory purchases are an asset until it is sold. Next up are retail sales transactions, a liability demon that can really mess up your books. Why? Because sales tax is usually a pass-through item, which means it stays on the balance sheet. The gotcha here is sales tax is not income. It's a liability until it gets paid. It never ever hits the profit and loss statement unless there is a discount involved. Let's take a look at how this works for transactions processed directly in QuickBooks. It's a two-step process. In step 1, the customer pays the tax to the business. This results in entry 1 on the books. Record the cash collected as a deposit from the sale of an item. In this case, a computer. The bank account, the sales tax liability account, and an income account for the computer sale all increase when this happens. In step 2, the business pays the tax to the governing agencies. This results in entry 2 on the books. Record the tax payment to the governing agency. The sales tax payable decreases. An income account called sales tax adjustment increases because the business got a discount for paying the taxes early, and the bank account decreases. And that's how all of this works. Now let's look at retail sales transactions processed via a point-of-sale system. The gotcha here is usually one of two things. Point-of-sales transactions may come down into QuickBooks as hundreds of separate items in various accounts, or they may come down net as an increase to cash and an increase to income or sales. Either one of these situations is a serious liability because manual entries are required to adjust accounts on the books. Without getting into too much detail here, there are at least 4 accounts that must be properly recorded, preferably monthly. Product or sales income, sales tax payable, the provider service fee, and cash received, usually an automatic side of the entry. Make sure you know how this works. This demon looks pretty innocent, doesn't he? Actually, kind of cute in a way. But there is nothing innocent about these 2 QuickBooks Gotchas. They are 2 very dangerous accounts. Let's talk about undeposited funds first. This is a place to store customer funds until a bank deposit is made. It allows you to enter multiple checks as a single deposit. It sounds like a wonderful feature, but if it isn't managed properly, it can result in duplicate income entries, which may be hard to correct. So, be sure you understand how it works or simply turn it off. And next, let's talk about an account called Ask My Accountant. This is a place to store transactions when you don't know how to code them. It is supposed to be a temporary holding account for finance keepers who need help from a professional. The problem is, it becomes a dumping ground if left unattended. The longer it sits, the larger it usually gets and the harder it is to clean up. I recommend avoid this account. Get the help you need right away. Oh my gosh, there are so many gotchas. We've covered a lot, I know. So it's time to pause now and do a homework assignment. Reflect on the gotchas for a while and then 1. Answer the question, what are the 3 demons you fear the most? And 2. Briefly describe why for each one of these. You can do more, and I hope you do, so we can cast out those demons when we get together, one by one by one. Okay, I hope I haven't scared you too much with all of these gotchas. But then again, we are talking about some serious issues that stifle a business, that prevent growth, issues that can even destroy a business. I've seen it happen too many times. The devil is in the details, I have to say, and you have heard a lot of details today. In summing it up, starting with Spreadsheets-Demon Category 1, I have to say that keeping your books in a spreadsheet is almost ridiculous to me. It gets out of hand really fast. Spreadsheets are a tool for analysis. They should not be used for your primary record system. And in the end, it usually costs you a whole lot more money when you get to the tax accountant at the end of the year. As for Commingling-Demon Category 2, it simply doesn't make sense at all because at a minimum, it costs you more money to get your tax return done for the business. And more importantly, it severely reduces the value of your business. I have had numerous clients who could not buy or sell because of this demon. The books were so severely commingled, it was far too much trouble to unwind the mess and come up with a value. How sad is that? So, keep 2 sets of independent financial records, one for your business and one for your personal needs. And finally, accounting pitfalls, Demon Category 3. These are borderline sinful because all of them can be avoided. The books don't have to be a great big mess. All you need is some knowledge. So, work with a coach and or maybe pay for some help if you need it. Don't be cheap at the risk of losing your business or understanding its value. The good news is you are here today learning about all these gotchas, and there is really no bad news unless you don't take any action. You live with the risk of demons infiltrating your books, and you pay your tax accountant to clean up the mess every year, if that's even possible. I have one client who hasn't filed a tax return for 3 years because he can't unravel the mess. So, I say, be proactive. Either do the books yourself and get some help in the process, or hire somebody to do your books. But make sure you hire someone who knows what the heck they are doing and who understands what kind of finance-keeping records you need to manage your business, to measure performance. 2 other things before you go. 1, make sure you have a copy of the reference guide called Getting Your Books Up and Running. It's right here on my website. And 2, join me for for part 3 of this series. It's all about how to manage your business once you have it up and running. So, for now, subscribe to the Butterflies Pause channel below and get started on your homework assignment. I'll see you the next time.